President Trump imposed a 25% tariff on steel and aluminum imports earlier this week. For more on the potential impact on commodities, the energy sector, and the markets, we want to get to our next guest, Jeff Currie. He is Carlyle Chief Strategy Officer of Energy Pathways. And Jeff, it's been a while since we've gotten to talk to you. First of all, how are you doing?
I'm doing well, Becky, and it's good to see you. I'm glad to be back here talking about the commodities.
Yeah, there's a lot to talk about. Steel and aluminum prices, we've watched what's happened with the stocks. I guess the commodity is a more interesting thing to kind of take off. Obviously, American companies, their stock prices did benefit from the tariffs that are going to be imposed. What's it been doing to commodity prices overall?
Well, when you look at like aluminum, it's priced it in almost entirely in places like the Midwest premium for LME aluminum. I think the point you make, like Alcoa, it really didn't price it in. So the question is, why did the commodity market price it in and Alcoa didn't? I think it simply goes down to three factors. One, it's going to take 2 to 5 years to bring on new supply. We think the deficits are so large that the persistence of such a large tariff is probably not sustainable. Second thing, I like to point out, if you think AI is power intensive, aluminum's a whole different world. It is 6 times more power intensive than AI data centers. So bringing it onshore in an environment in which AI data centers are already expected to consume any excess power, this would be incredibly disruptive to power grid. There's a reason why it was outsourced to begin with. And then I think the third point to keep in mind is, big tech missed earnings last week because the growth in cloud data missed their targets. Why? Because they didn't have access to things like transformers. What are transformers? They're just big chunks of metal. So if you put tariffs, disrupt these supply chains, it just aggravates that situation. I think that's why, Alcoa didn't price it in, but the commodity markets have fully priced it in over the next 2 to 3 quarters.
We've got the inflation numbers that we saw yesterday on the consumer level. Today, we're getting producer prices. How does this play into producer price inflation? Not that we're going to see in today's print, but let's say 3 to 6 months down the road.
It's very significant. I mean, when you look at, the rises in, take that Midwest premium for aluminum, you're up 25%. It priced in those targets perfect, or the tariffs perfectly. You look at COMEX high-grade copper, it's up 10 to 12% right now. These are major inputs into basic production across the supply chain. And I want to point out, in that hot inflation report yesterday, it was things like transportation equipment, which are what? Metal consumers, where you actually saw the inflationary pressures. So, I think this is very significant.
Jeff, we've talked about how hard it is to try to move away from fossil fuels and how long it's going to be. And, it finally made its appearance in the Wall Street Journal, an op-ed piece on Landman, out of Hollywood. There's actually something that shows how essential fossil fuels are to this world that we've built and the way you do it. But one thing that becomes clear, even why it's just a TV show, but they do point out the oil industry likes $60 to $80 oil. If it's under 60, things become very dicey for the producers. And it really matters that at like 70, 75, that's perfect. If we drill, baby, drill, like President Trump wants to do, and Doug Burgum, and we keep hearing about it, how that's going to be a panacea and like our golden ticket to everything good in the world. Can't that be self-defeating if we produce too much, or if we overdo it? Won't prices collapse and then we go through a bad spell?
For one, I don't think you can overdo it. I mean, these producers have made it clear. Regulation is not the constraint on their ability to raise production right now. But I want to go back to your point about, low oil prices being bad for the U.S. This is not 1970 United States. This is 2025 United States. It produces more oil than Saudi Arabia and Russia combined. It's 20 million barrels per day of oil production. As you point out, oil prices go down below 65 or 60. U.S. has a problem. If you think about, even on the upside, it may hurt the consumers in places like Chicago and Michigan temporarily, but it will benefit them in the longer term because you get more CapEx, more investment. So when we look at the U.S., it's a benefactor from higher oil prices. So you're spot on. But I think about those fears of prices coming down and creating a, due to drill, baby, drill. U.S. production hit 13 million barrels per day on the eve of COVID. It dropped down to 10. It came back to around 13.2. So between 2019 and today, we're still roughly 13 million barrels per day on liquid oil production. You get to the 20 by adding in NGLs and other types of liquids, but black crude oil, it's roughly 13. I think you're going to really stress the system to get it above 13.4, 13.5. So when we think about the ability to drill, baby, drill, even the administration has toned down the barrels of production and called them barrels of oil equivalency to be able to address it as gas as opposed to oil.
I don't know what all that means then. So it's kind of a pipe dream then that we can't produce more.
Yeah, I think it'll be really difficult to add, that their target is 3 million barrels per day. And that's the reason why they quit calling it 3 million barrels per day and called it 3 million barrels of oil equivalency per day.
So what happens with Canada if they decide to put tariffs on the energy that they are sending us?
Well, I think, one, when you look at the ability for them to redirect oil out the West Coast through Vancouver into places like China, you're already seeing every effort to move those barrels elsewhere in the world, which is creating shortages of products in places like the mid-continent. You look at product markets around the world, they're at very, very tight levels at this point right now. So we're starting to see barrels being redirected. Not only do you have the tariff situation in the U.S., but you also have, Russian sanctions biting, Iranian sanctions biting. Overall inventories are the lowest levels they've been since, going back decades. So market's tight. You can see it in the front of the forward curve, which suggests, the risks are still skewed to the upside right now. The question you're probably asking, why doesn't the price price it in right now?
Why hasn't gone in? Right.
Investors have no interest in coming to this space. And when we look at, the amount of leverage in the market, given where interest rates are, the cost of capital, people shun these markets, all of these markets, whether if it's aluminum, copper. The old economy is still very much out of favor right now. And you have to get expected returns high enough relative to, say, like big tech before you're going to see capital move in here. Another way to say it is, in the 2000s, when we got bullish on oil, the market would price it in because it saw the upside. Today, it's not going to price it in until you drive over that pothole.